Good evening. This is Doc Severson for the Theo Night Report for Thursday, November 9th. Let me start off tonight's report with a statement. If you are not tracking the S&P 500 weekly expected move, then you're missing out on a great signal. So this is what we do every week. We track the S&P expected move based on what is showing in the option chain. I'll show you that in just a second here. But every weekend, what I do is I go along here and on the spiders, it doesn't matter whether you use the spiders or whether you use the SPX. What we're doing is we're tracking the upper and lower expected move based on the starting price and then the expected move plus or minus. So typically, we're seeing the expected move on a weekly basis plus minus about 2.1, 2.2 points on the spiders, which is 21 to 22 handles on the full S&Ps. And you can find those expected moves if you go to the option chain and pick out the back week, or actually for front week for tomorrow, we have a plus minus 1.1 point expected move. So that's about 11 points on the full S&Ps. Plus minus 11 points is our expected move into tomorrow's close. But typically what we'll do is we'll go out here to the expected move for the next week. So 17 November is the one I want to look at here. And actually it's showing a plus minus 3.13 points. Now it's got to get through tomorrow, but I would assume that on Saturday, that's going to be above the typical plus minus 2.1 value that I'm going to look at. And what that means to me is that volatility is going to start to pick up in the market. This is what the market is telling us in terms of forward projected volatility. Now, the other thing that we can see, and I'm going to an intraday chart here on the SPX, is that the lower expected move value for this Friday was 25.66, and it hit it almost exactly. I mean, within 1 point it hit that, and you'll see that in today's market action, which we'll talk about in just a minute here, is that we were heading straight down until it hit that level, and then it stopped and reversed and did the full V-bottom. If you're not tracking this level, you need to ask yourself why. It only takes minutes a week. Now, the second thing I want to bring to your attention is notice today's price action. Can you see it? Probably not. You probably have to zoom in on this chart and look in the upper right, and then we have to zoom in on this and we have to see what actually happened today. And to some degree, that shows the amount of risk that's out there today, because you can barely see any of the movements now. And when we start to get real movement, you will see those. Now, the other thing to keep in mind is just the percentages up here. Okay, so from yesterday's close to the bottom of today's action was about 28 handles on the S&P. Now, for those of you that have been trading the S&P for a number of years, I'll go back 10, 15 years and think, wow, a 28 handle range on the day, that's pretty big. And that might have been the case back when the S&P was at 1,000, trading in that range between 1,000 and maybe 1,500 or so. It's a fairly big day. But when you look at the price of the S&P near 2,600, that's only about a 1.1% range. So that just goes to show you that a day like today, which induced a lot of panic from a lot of traders that have never really traded through any kind of distribution that's out there, any kind of this distribution, they don't know what they're in for when we do start to get volatility. So it's very important right now that you pick up clues if we are starting to increase in volatility, because it will affect every strategy that you trade. So again, a 1% day on the full S&Ps, that's not very big. So we have to keep things in context and keep things relative to what the actual volatility is. Imagine what would happen if we did have a 2% or a 3% day. So now we'll switch over to the Dow Futures. And again, the same question is, can you see today's price action up in the upper right-hand corner? Not really. So we have to zoom in on that to see what's going on. Okay, so for the Dow, we actually had a full range of about 285 points. Sounds like a lot, doesn't it? Sounds like a huge day that we had. Sounds like something akin to what we went through back in 2008. But no, when we normalize that number of 285, that's about 1.2%. That's about a 1.2% day. So Another conclusion that we can come to is that the historical or realized volatility that we've been seeing lately is so low that I think people are getting too complacent. They're not used to this volatility. So when we come along and have a 1.2% day on the Dow, and all of a sudden it's the headline news that's out there, we need to reset our expectations. Okay, so next we'll go over to the Nasdaq Futures and say, can you see today's price action? No, not really. It's maybe that little red thing way up in the upper right-hand corner. Okay, so today on the Nasdaq, we have about 107 points of range, which is good. That sounds good, but again, that's only about a 1.7% normalized number. So I want to go back to what I've been saying lately. I want to be consistent about this because if there's one thing I've seen which has occurred over and over and over again, it's that when we get into these quiet and trending markets that go completely parabolic, the very first thing that starts to happen is, well, first of all, let me dispel the notion that some people seem to think that we're going to have a day like this, where we're going to give all of that back in one day. That is not going to happen. Without exception, going back 100 years, the way that volatility gets introduced to a market is, first of all, instability. So what happens is from these extremely quiet beginnings, you start to see volatility tick up. So you start to see it increase like this. And then eventually what occurs will be what I call a shot over the bow. We do have a big day that comes along and just scares everybody to death. Now that will give us literally months of volatility. Now, the big thing to determine from that point is one of two things can happen. Either this tends to break out and resolve to the upside, similar to what we had back in 2016, or it can also break down and resolve to the downside. And really, there's no other word to call it. It turns into a bear market. And the last time that we honestly saw that was in 2007, 2008. Very end of 2007 is when it started. But we've seen many, many of these along the last 8 to 9 years where we did get that increase in volatility and it just resolved to the upside. We saw the increase in volatility and it resolved to the upside. So about 80% of the time it actually will resolve to the upside. So one of the second things that I'll say here is that when we do get the volatility, the highest probability is that at least on the first shot down, that we will typically hit new highs in price. So even that first scary shot down to the downside will ultimately end up with higher prices before we do see more weakness coming on board. So this is another way of saying that if we are going to start unwinding now, if we're going to start to see risk coming back into the market, we're just in the very first inning of this. This is a long, drawn-out process before markets start to really correct. So the other way to put this is that bottoms are an event, tops are a process. It takes a long time for these things to become unstable and start to unwind to the downside. So, in summary, watch those expected moves on a weekly basis. It doesn't take that long to figure them out. And watch that average true range. Watch that ATR. Watch the volatility. Watch the realized volatility as well as the implied. The implied will give you the forward projection. The realized will tell you what's actually happening right now. And don't forget to normalize today's prices with percentages so that you're not surprised when we start to see bigger moves that are more appropriate for a much higher price market. That is it for today's report. Thanks for listening, folks. We'll see you tomorrow.